Welcome to our lecture video. In this lecture, we are going to study one of the most important ideas in corporate finance, the cost of capital, WACC, and project-specific discount rates. This topic sits at the center of financial decision-making. Whenever managers evaluate an investment, they usually forecast future cash flows and bring those cash flows back to the present. But the discount rate they use is not just a technical detail. It is the price of risk. A project may look attractive when the discount rate is too low. But if the project is actually risky and investors require a higher return for bearing that risk, then the same project may destroy value. So the main question is simple but powerful. What return must this investment earn to compensate the capital providers for the risk of the cash flows? That question gives us the logic for the entire lecture. The discount rate should reflect the risk of the cash flows. It should not reflect personal preference, accounting labels, or the source of financing by itself. By the end of this lecture, you should understand what the cost of capital means, how it's interpreted, when firm-wide WACC is appropriate, and why some projects need their own discount rate. Let's begin with the people and institutions who provide capital to a firm. A firm may raise money from debt holders, common shareholders, preferred shareholders, private lenders, venture investors, or other capital providers. Each group has a different claim on the firm's cash flows, and because each claim has different risk, each group requires a different expected return. Debt holders usually receive promised interest and principal payments. Their claim has contractual priority over equity. Because they are paid before shareholders, debt is often less risky than equity for the same firm. That is why the cost of debt is often lower than the cost of equity. Equity holders are different. They receive residual cash flows. They benefit when the firm performs well, but they also absorb losses after other claims are paid. Since equity is riskier, equity investors usually require a higher expected return. Preferred shareholders, when present, often sit between debt and common equity. They may receive fixed dividends and have priority over common shareholders, but they usually do not have the same protection as lenders. The key idea is that the cost of capital is forward-looking. It's not about what the firm paid in the past. It's about what investors require today for investments with comparable risk. Let's now focus on the cost of debt. The cost of debt is the return lenders require on the firm's borrowing. For publicly traded bonds, analysts often use the bond's yield to maturity as a market-based estimate. The yield to maturity reflects the return debt investors currently require, given the bond's price, maturity, credit risk, and market conditions. This is an important distinction. The coupon rate is not necessarily the current cost of debt. The coupon rate tells us the promised interest payment on an existing bond. But the cost of debt should reflect today's opportunity cost. If market rates or credit risk have changed, the old coupon may no longer represent the return lenders require now. For firms without traded debt, analysts may look at recent borrowing rates, comparable credit spreads, bank loan terms, or synthetic credit ratings. The goal is always the same. Estimate what the firm would pay today for debt with similar risk and maturity. Debt also receives special treatment in WACC because interest payments are often tax deductible. When interest reduces taxable income, the effective cost of debt to the firm becomes lower than the pre-tax borrowing rate. But this tax benefit requires judgment. If the firm cannot fully use the tax shield, or if tax rules limit deductibility, then a mechanical tax adjustment may overstate the benefit of debt. Next, let's discuss the cost of equity. The cost of equity is the expected return required by common shareholders. Unlike debt, equity usually has no promised coupon and no fixed maturity date. Because of that, the cost of equity must be estimated rather than directly observed. A common approach is the capital asset pricing model. You will see the equation in the background, but the intuition is more important than memorizing the symbols. The model connects the cost of equity to the risk-free rate. the stock's systematic risk, and the expected reward for bearing market risk. The most important concept here is opportunity cost. Shareholders could invest their money elsewhere in securities with comparable systematic risk. So when a firm uses retained earnings, issues new shares, or reinvests cash that could have been distributed, the firm must earn enough to compensate shareholders. The cost of equity is not an accounting expense like wages or rent. It is not written as a bill that arrives in the mail, but it is very real. If the firm fails to earn the required return for equity risk, shareholder value is reduced. Equity often costs more than debt because equity holders are residual claimants. But that does not mean equity is bad. Equity provides flexibility, absorbs losses, and can reduce financial distress risk. The real question is not which source looks cheapest alone, but which financing mix supports value creation. Now we are ready to bring debt and equity together through WACC, the weighted average cost of capital. WACC combines the required returns of capital providers using capital structure weights. These weights should usually be based on market values, not book values. Why? Because the cost of capital is an opportunity cost. Investors care about the value of capital they could invest today, not the historical values recorded on the balance sheet. Book values can be misleading when a firm has old assets, accumulated depreciation, internally generated intangible assets, or major changes in market conditions. Market values better reflect current investor expectations. In practice, analysts often use a target capital structure. This target reflects the financing mix management expects to maintain over time. The target structure may differ from the current structure if the firm is temporarily overlevered, underlevered, or moving toward a long-run financing policy. The WACC formula you see behind me is the standard structure for combining debt and equity. The debt component is usually adjusted for taxes, while the equity component reflects the required return for shareholders. But remember this carefully. WACC is not simply the average interest rate paid by the firm. It includes debt and equity. It reflects current required returns and market value weights. When used correctly, WACC is the discount rate for free cash flows generated by the firm's operating assets and available to all capital providers. A firm-wide WACC is useful, but only under specific conditions. It is most appropriate when the project being evaluated has risks similar to the firm's existing operating assets, and when the project will be financed in a way consistent with the firm's target capital structure. In plain language, firm-wide WACC works best when the project looks like the firm's normal business. The project should have similar sensitivity to the economy, similar operating leverage, similar cyclicality, similar competitive risk, and it should not materially change the firm's long-run financing policy. When these conditions hold, WACC can serve as a practical estimate of the required return. The firm is essentially asking whether another investment in its existing risk class earns enough to satisfy the same mix of debt and equity investors. But many strategic decisions do not fit this pattern. A stable company entering a highly uncertain industry, a software firm buying a manufacturing business, or a mature firm launching a very cyclical product may face risks very different from the firm's existing assets. In those cases, the firm-wide WACC can lead to poor decisions. This brings us to the matching principle. The discount rate must match the cash flows being valued. Free cash flow to the firm is usually discounted at WACC. Cash flow to equity is discounted at the cost of equity. Debt cash flows require a debt-based rate. Different risk requires a project-specific rate. Let's now pause and look at common WACC mistakes. These mistakes are easy to make, and they can seriously distort valuation. The first mistake is using book value weights instead of market value weights. Book values reflect accounting history. Market values better represent the current opportunity cost of capital. The second mistake is using the coupon rate instead of the current cost of debt. The coupon rate belongs to an old borrowing decision. The current cost of debt should reflect today's required return for debt with comparable risk. The third mistake is ignoring the tax shield on debt when interest is deductible and the tax benefit is expected to be usable. In the standard WACC approach, the debt component is usually after tax. Another common mistake is using one WACC for every project. Firm-wide WACC is an average. It is not a universal hurdle rate for every investment the firm might consider. Managers also sometimes confuse the financing source with project risk. A project funded with cash is not automatically risk-free. A risky project does not become low risk because management chooses to finance it with debt. The discount rate should follow the risk of the cash flows. Finally, analysts must avoid mixing nominal and real inputs, mixing currencies, or adding arbitrary risk premiums without clear reasoning. A strong analysis is consistent, disciplined, and transparent. Let's now move to project-specific discount rates. A project-specific discount rate is a required return matched to the risk of a particular investment. It may differ from the firm's overall WACC if the project has different business risk, operating leverage, financial leverage, currency exposure, or sensitivity to market-wide conditions. The logic is straightforward. The discount rate should follow the risk of the cash flows, not merely the identity of the firm evaluating the project. Imagine a mature company evaluating a routine replacement project and a highly uncertain new venture. The routine project may have risks similar to the firm's existing operations. The new venture may have very different risk. Using the same WACC for both would distort the decision. This is where project-specific rates become valuable. They help prevent cross-subsidization. Low-risk divisions should not be penalized by a high company-wide hurdle rate. High-risk divisions should not receive capital just because the firm-wide WACC is lower than the return investors would require for that risk class. The goal is not false precision. Finance is not about pretending we can know every input perfectly. The goal is to avoid using an average discount rate when the project is clearly not average. For diversified firms, this logic often leads to divisional costs of capital. Each business unit should be evaluated against a benchmark appropriate for its own asset risk and target financing. How do analysts estimate a project-specific or divisional cost of capital? One important approach is the pure play method. The pure play method uses comparable publicly traded firms that operate primarily in the same business as the project or division. These firms provide market evidence about the systematic risk of the assets being evaluated. The process begins by identifying comparable firms. Then, analysts estimate the equity beta of each comparable firm. But equity beta reflects both business risk and financial leverage. So the analyst removes the effect of financial leverage to estimate an asset beta. This is often called unlevering beta. After that, the analyst averages or synthesizes the comparable asset betas. Then, the asset beta is adjusted to reflect the target capital structure for the project or division. This is called relevering beta. The resulting beta can be used to estimate the project's cost of equity. And then the project-specific WACC can be computed. The intuition is simple. Business risk and financial leverage are not the same thing. We want to understand the risk of the operating assets first, and then apply the financing policy that is appropriate for the project. The pure play method is especially useful for new divisions, acquisitions, private businesses, and investments outside the firm's existing operations. Still, it requires judgment. Comparable firms may differ in geography, size, product mix, regulation, operating leverage, and growth opportunities. Good analysis explains those choices clearly. Let's bring everything together with the managerial interpretation. The cost of capital is the link between capital markets and managerial decisions. Investors set required returns based on risk. Managers use those required returns to decide whether projects create value. A project must earn more than the return required for its risk. It is not enough for a project simply to have positive expected cash flows. The project must compensate the capital providers for the risk they bear. Debt may appear cheaper than equity, but additional debt also increases financial risk. Market value weights are usually more relevant than book value weights. Firm-wide WACC is an average required return, not a universal hurdle rate. And most importantly, the discount rate should match the risk, currency, timing, and claim structure of the cash flows being valued. The practical danger is clear. If managers use a discount rate that is too low, they may accept high-risk projects too easily. If they use a discount rate that is too high, they may reject valuable low-risk projects. Both errors can destroy value. So when choosing a discount rate, ask 3 questions. Whose cash flows are being valued? What risks do those cash flows expose investors to? What financing mix is expected to support those cash flows over time? Here is the main rule. Use the required return for assets with comparable risk and apply it to cash flows measured on the same basis. Thank you for watching. I will see you in the next video.